Imagine a world without money. How would we trade? How would we value goods and services? From the earliest days of human interaction, the need to exchange has been fundamental. We exchange goods, services, and ideas. Currency, in its many forms, has been the bridge across which this flow happens. For millennia, this bridge was built with tangible things, shells, stones, precious metals. But as societies grew and interactions became more complex, the bridge needed to evolve. This evolution led us to the currencies we know today: coins, banknotes, and increasingly the ones and zeros that flow through the digital veins of the internet. Each iteration built upon the previous, addressing limitations and reflecting the technological advancements of its time. The bridge of exchange is being rebuilt once again, this time with digital bricks and mortar. This begs the question, is cash in its physical form becoming obsolete? The move towards a cashless society is gradual, a slow but steady current carrying us towards a new financial landscape, from the barter systems of our ancestors to the invention of coinage, from the adoption of paper money to the rise of credit cards and electronic banking. The story of currency is a story of innovation and adaptation. Today, that flow is increasingly digital. The internet and mobile technology have created a world where transactions can happen instantaneously across borders and with a few taps on a screen. This ease of use, coupled with the growing concerns about the security and hygiene of physical cash, has fueled the rise of digital currencies and mobile payment platforms. In the beginning, there was no currency as we know it. Before coins, before banknotes, before the very idea of money, there was a more fundamental system of exchange barter. A farmer, for instance, might have an abundance of wheat, but need tools to cultivate his land. A blacksmith skilled in shaping metal might be willing to trade his tools for a supply of food. This direct exchange of goods and services formed the backbone of early economies. It was a system built on necessity and mutual benefit, a way for people to get what they needed by offering what they had in surplus. This system, while seemingly straightforward, relied on a crucial element: the coincidence of wants. The limitations of barter would eventually pave the way for the invention of currency. Barter, at its core, was a system of direct exchange. One good or service was traded for another, with no intermediary instrument like money involved. This system worked well in small, close-knit communities where people knew each other's needs and possessions. If a farmer needed a new clay pot and the potter needed a sack of grain, a simple barter trade could be agreed upon. The value of the goods was determined through direct negotiation, based on factors like scarcity, quality, and the immediate needs of those involved. This problem, known as the double coincidence of wants, became a major obstacle to economic growth and development. The limitations of barter extended beyond the difficulty of finding suitable trading partners. The absence of a standardized unit of value made it challenging to establish fair exchange rates. Transporting large or perishable goods was impractical, and dividing a live animal to purchase smaller items was simply not feasible. These limitations highlighted the need for a more versatile and efficient medium of exchange. This need, born from the growing complexities of human interaction, would lead to the invention of money. The need for a more efficient and flexible medium of exchange led to the emergence of commodity money. Unlike bartering, where goods were directly exchanged, commodity money introduced the concept of a common intermediary, an object of intrinsic value that could be used to represent and measure the worth of other goods and services. Initially, these commodities varied from culture to culture, reflecting locally available resources and shared values. Shells, beads, salt, cattle, and even tools served as early forms of money. These objects held inherent value beyond their monetary use. This intrinsic value provided a sense of trust and stability in the early marketplace. People understood the worth of the commodities being used as money, even if their value fluctuated based on supply and demand. The use of commodity money addressed some of the limitations of barter, but it also presented new challenges. These challenges would lead to the refinement of commodity money, eventually favoring durable, divisible, and easily transportable materials like gold and silver. As trade routes expanded and civilizations interacted more frequently, certain commodities emerged as particularly well suited for use as money. Gold and silver, with their unique properties, quickly rose to prominence. Their rarity, durability, divisibility, and inherent beauty made them ideal mediums of exchange. Gold and silver could be easily stored, transported over long distances without degradation, and melted down to create standardized units of value. Coins. The invention of coinage, stamped with the seals of rulers and empires, brought a new level of trust and uniformity to trade. A gold coin from one kingdom held a similar value in another, simplifying commerce across borders. The adoption of gold and silver as standardized forms of currency ushered in an era of unprecedented economic expansion. Beyond barter, the advantages of commodity money. The shift from barter to commodity money, particularly gold and silver, brought about significant advantages that fueled economic growth and societal development. The inherent value of these precious metals instilled confidence and stability in the marketplace. People understood the worth of gold and silver even if the forms they took, coins, jewelry, or ingots, differed. This shared understanding facilitated trade and reduced the risk of disputes over value. The durability of gold and silver ensured their longevity as a form of currency. Unlike perishable commodities like grain or livestock, these metals could withstand the test of time. This characteristic was crucial for accumulating wealth and passing it down through generations. The promise of paper. The use of gold and silver as currency, while a significant leap forward from barter, came with its own set of challenges. The weight of these precious metals, especially in large quantities, posed logistical problems. Transporting chests of gold or silver for large transactions was cumbersome and risky, susceptible to theft and loss. The need for a more practical and portable form of currency became increasingly apparent. This need gave rise to a revolutionary idea: paper money. Initially, paper money emerged as a form of promissory note, representing a claim on a specific amount of gold or silver held in reserve. This system, based on trust and convenience, paved the way for the widespread adoption of paper money. Trust, the foundation of fiat currency. Fiat currency derives its value not from an underlying commodity like gold, but from the trust and confidence bestowed upon it by the issuing government. This trust is built on the government's guarantee that its currency will be accepted as legal tender for all debts, public and private. In essence, fiat currency represents a social contract, a shared belief in its value that enables it to function as a medium of exchange, a unit of account, and a store of value. Fiat currency could be printed or issued electronically as needed to stimulate growth, manage inflation, and respond to economic crises. However, this flexibility came with its own set of risks. Section 3. The rise of central banks and national currencies. The adoption of fiat currency went hand in hand with the emergence of central banks and the consolidation of national currencies. Central banks, established by governments to oversee and manage their monetary systems, played a crucial role in stabilizing currencies, controlling inflation, and promoting economic growth. They acted as lenders of last resort, providing liquidity to banks during financial crises, and implemented monetary policies to influence interest rates and control the money supply. The rise of national currencies, backed by the full faith and credit of their respective governments, further streamlined economic activity within nation-states. The value of a nation's currency became intertwined with its economic and political stability, its creditworthiness, and its role in international trade. Section 1. The Digital Revolution. The latter half of the 20th century witnessed a technological revolution that would profoundly impact the world of currency: the digital revolution. The invention of computers, followed by the internet and mobile technologies, created new possibilities for storing, transferring, and managing information, including financial data. This digital transformation gradually permeated the financial sector, leading to the automation of banking systems, the introduction of electronic funds transfers, and the rise of online payment platforms. Transactions that once required physical presence at a bank or institution could now be conducted remotely with unprecedented speed and efficiency. This digital revolution laid the groundwork for the emergence of entirely new forms of currency existing solely in the digital realm, cryptocurrencies. Section 2. The rise of digital currencies. Cryptocurrencies, with Bitcoin emerging as the first and most well-known example, introduced a radically different approach to the concept of money. Unlike traditional currencies issued and regulated by governments, cryptocurrencies operate on decentralized networks, utilizing cryptography to secure transactions and control the creation of new units. Bitcoin, created in 2009, captured the imagination of early adopters and tech enthusiasts. It offered a glimpse into a future where financial transactions could occur directly between individuals without the need for intermediaries like banks. This peer-to-peer system, enabled by blockchain technology, promised greater transparency, lower transaction fees, and increased privacy. The success of Bitcoin, despite its volatility and regulatory challenges, sparked the creation of numerous other cryptocurrencies, each with its own unique features and intended use cases. Ethereum, for example, went beyond Bitcoin's focus on transactions to enable the creation of decentralized applications and smart contracts. The rise of cryptocurrencies, while still in its early stages, represents a potential paradigm shift in the world of finance. It challenges the traditional role of governments and central banks in controlling monetary systems and introduces new possibilities for how we think about money, value, and exchange in the digital age. Section 3. A cashless world: advantages and concerns. The increasing digitization of currency and the emergence of cryptocurrencies have sparked widespread debate about the potential benefits and drawbacks of a cashless society. Proponents of a cashless future highlight the potential for increased efficiency, transparency, and financial inclusion. Digital transactions leave a traceable record, making it more difficult to engage in illicit activities like money laundering and tax evasion. This transparency can foster accountability and reduce corruption. Furthermore, digital financial services can reach underserved populations in remote areas or those without access to traditional banking infrastructure, promoting financial inclusion and economic empowerment. However, the transition to a cashless society also raises valid concerns. Privacy advocates worry about the potential for surveillance and data breaches in a world where all transactions are recorded and tracked. Cybersecurity risks become paramount as digital systems are vulnerable to hacking and fraud. The digital divide, the gap between those with access to technology and those without, poses a significant challenge. A cashless society could exacerbate existing inequalities, excluding those without access to digital devices or reliable internet connections from fully participating in the economy. Section 4. The future of money: a balancing act. The future of currency is evolving, shaped by technology, consumer behaviors, and regulations. Cash is diminishing, while digital payments, mobile wallets, and cryptocurrencies offer unmatched convenience. Governments explore central bank digital currencies to enhance monetary systems and maintain control. Balancing innovation and regulation is crucial for a stable financial system. Section 1. The end of cash. Is this the end of cash as we know it? Will our children see physical money only in museums? The move towards a cashless society is gaining momentum. We can now purchase goods with a tap of our phones and manage our finances with a few clicks. Yet cash persists. It remains a tangible symbol of value. For many, access to digital financial services remains limited. And let us not forget the anonymous nature of cash. The future of currency is likely a hybrid model where physical and digital forms of money coexist. Governments are exploring digital currencies, seeking to harness blockchain technology while maintaining control. Ensuring equitable access and addressing privacy concerns are paramount. The future of currency is about creating an inclusive, stable financial system. Section 2. The future of exchange. The story of currency, from barter to Bitcoin, is a testament to human ingenuity. It reflects our evolving understanding of value and trust. As we stand at the cusp of a new era, the possibilities seem endless. Imagine a world where micropayments unlock a plethora of online content and services. Picture cross-border transactions happening seamlessly and instantaneously. Envision financial services tailored to individual needs, empowering wealth management. The future of exchange is about more than just money. It is about the flow of value, creating a global marketplace where ideas, skills, and resources can be shared with ease.